Investors Chronicle.
Hello and welcome back to the IC interviews. After a couple of weeks off over Easter, we're raring to go. I'm Mary McDougall and I'm delighted to be joined by Ken Wotton, Head of Public Equity Investments at Gresham House. Ken has worked in financial services for over 25 years, or 26 on my count, first training as an accountant and then as a research analyst. He spent a decade at Livingbridge, where he headed their quoted market investments with a focus on smaller companies, and is now co-manager of Gresham House UK Microcap Fund, Gresham House UK Multi-Cap Income Funds, and manages AIM-listed portfolios on behalf of Baronsmead VCTs. He is also manager of Strategic Equity Capital Trust, a position he has held since September 2020. Ken, thank you for joining me. How are you?
I'm very well. Thanks for having me.
Well, that's a lot of funds there pinned to your mast. I wondered how you split your time across them.
Well, we don't sort of timesheet ourselves and allocate sort of certain percentages of time to individual funds. I think we operate very much a team-based approach. So there's a team of 5 of us who are managing all the public equity funds, and whilst my name might be on various different vehicles, it's the team of 5 plus a wider private equity team of 20 people within Gresham that gets involved in all elements of the investment process. So I'm sort of taking a strategic lead on those funds with my name on it. But I put my time where it's needed, and we have a lot of resource.
Yeah, sorry, that was a bit of a mean first question. But a lot of the funds are specifically small cap. The multi-cap fund one does look like it's got a bit of a small cap bias. What's your outlook for UK small caps at the moment? It's been a bit of a trickier environment. They've underperformed larger caps over the past year. What's your sort of state of play now?
Yeah, look, so I think, first of all, we're in an environment, have been for the last 5 years plus, that where UK equities appear to be undervalued or at least trading at a material discount to other developed markets. And then within that, you've got what I wouldn't say it's completely structural, because there are points in a market cycle where it changes. But for most of the last few years, UK smaller companies have traded at a material discount to larger UK listed companies. So we're in an area which I think is structurally undervalued. And therefore, if you're selective and you can find high quality companies that are sort of suffering from a valuation discount by virtue of the asset class they sit in, then that could be a really exciting place to find good sort of long-term opportunities to make money. So that's the kind of big picture. The current market environment is volatile. There's lots of uncertainty, macroeconomic and geopolitical. So it's an environment where there are lots of challenges, and you have to be very mindful to try and avoid banana skins on individual companies. But the quid pro quo for that is that actually the volatility in the market is throwing up some really interesting, exciting sort of entry points for businesses that where you can sort of see through the short-term transitory factors, and where you've got good long-term opportunities to grow and to take share or to grow margins and expand value. So I look at this environment with a glass half full and think that this is a great time to be making long-term investments.
Great. And when you say valuations are cheaper relative to larger caps, how do you value companies? What are your preferred valuation metrics? Because there are different ways to look at it.
We typically use either earnings or cash flow based multiples, and we typically look at on an individual company basis what is the right metric to value this business on, and we'll try and take our cue on that from how private equity would look at buying a whole company, or how trade buyers would value a whole business. So it might be free cash flow, it might be EBITDA, it might be EBIT, it could be net earnings. It depends on the individual company and what the sort of typically the precedent way of valuing a business in that space would be. We look at the multiples that we're paying today for that particular earnings metric, and then we look at what we think that metric can do over the life of our investment, and then what we think a fair multiple will be for those earnings if certain things happen as we predict in 3, 4, 5 years' time when we come to exit. So we try to bridge the earnings multiple today and the earnings multiple in 3 to 5 years' time, and sort of look at how we can make returns between those two numbers.
If we look at strategic equity capital in particular, what proportion of the holdings are profitable?
Well, all of the the companies that are sort of have underlying profitable business models. There are a couple in the portfolio that are temporarily not profitable because of issues to do with COVID. So, for example, we have a holding in a company called Hostel World, which is an online travel agent focused specifically on the niche market of people who are going to stay in hostels. Um, Obviously, because of COVID and the disruption both to traveling and the travel restrictions, but also people's desire to travel, and that business has been interrupted materially. It has cash on the balance sheet. It recapitalized itself during COVID, so we think it can trade through to sort of survive when markets recover. But temporarily, it's not profitable. But most businesses are profitable. We're largely seeking profitable businesses when we invest.
Yeah. You mentioned macro factors earlier when talking
Mhm.
about the climate for investing. I wondered to what extent it factors into decision making. And I ask this because it feels like we're in quite a different world from a couple of years ago. Inflation is up, war in Europe, spectre of higher interest rates. It does sound like you very much have a stock pricking approach, but has the macro landscape changed either your investment criteria or led to any buy or sell decisions?
So we don't make investments based on sort of trying to position ourselves explicitly for particular macro situations, and we don't change our sector weightings or such like as a result of our view on the macro. We try to, uh, I guess, be agnostic about macroeconomic factors, and try to pick high quality companies where either because they have structural growth drivers in their markets or because they have a specific competitive advantage that we think can endure, or because there are specific self-help things that they can do which will unlock value in the individual company, and that those factors will be more powerful than the wider economy. So whilst I'm not saying that our companies are immune to wider macro factors, our portfolios overall should be more resilient and less impacted by big macro factors than the wider market would be. So, in terms of what we've changed as a result of the current environment, um, well, I've made one recent change on the back of the geopolitical factors, and that was a company called Hive, which is a global exhibitions business, and it's a business which does have a material exposure to Russia. So one of its biggest shows is in Moscow. So it's a it's a it's a business which, it again, it's been impacted by COVID and travel restrictions and the propensity of people to go to face meetings. And just as it's been recovering from that, the Russia Ukraine thing has hit, and we figured that just the risk profile now is too great. They've subsequently said that they're exiting their Russian operations, but they are a material part of the business, and we're sort of then concerned about what the ramifications of that would be for its balance sheet. So it's a
Mm.
fundamental change to the investment case of that company, and not something we necessarily would have been able to predict. Um, but in terms of things like interest rates and inflationary cost pressures, it's clearly something that we're very mindful of. It's something that we talk to the company's management teams about, and it's an area where we're really sort of doubling down in terms of our risk assessment and kind of reevaluation of the companies. But we typically investing in companies that have pricing power, that, as I said before, have structural drivers or a strong competitive advantage, and we think they're well placed to manage sort of whatever comes to them from the macro space.
Yeah. Now, you took over the management, as I said earlier, of Strategic Equity Capital in September 2020. In your latest interim report, it says since then you've fully exited 9 investments and initiated positions in 7 new holdings. But also that there have been no fundamental changes in strategy. What would you say that the changes have been?
So when I took over managing the trust, which was September 2020, um, what I said at the time is that the strategy of the trust was as we wanted it to be, what it stated that it does, and that there was no fundamental changes we needed to make to the portfolio positioning. However, that over a period of 12 to 18 months, we would evolve the portfolio gradually and to try and position it more towards companies in the range of 100 to 300 million market cap, where we think there's a structural opportunity, undervalued companies, less well researched, and where we think we have a competitive advantage. And then, and also companies of that size where we can take bigger equity stakes. And because the trust is, explicitly a concentrated portfolio of companies where we're seeking to not just pick good companies, but also actively engage with them to try and sort of add value in whatever way we can. Where you have a larger equity stake in the company, that gives you a real platform to be able to do that engagement. So what we've done over that period has been to exit some of the larger market cap holdings in the portfolio, but we've done that with a view on the valuation and the returns that we expect to see. So we've sold a number of holdings that were, I guess you could call them COVID winners, where they'd been in sectors which had been relatively resilient during the pandemic, and where the market had sort of given them an extra rating kicker as a result of that resilience. And so we'd sold companies at high ratings, the larger market caps, and then reinvested the proceeds of those into some of the smaller cap names, either existing names within the portfolio or new companies which were on lower valuations. So that's kind of, so it's been more to do with the big divergence in sector and company performance from share price perspective since COVID,
Yeah.
rather than sort of us fundamentally changing the strategy.
Yeah, that makes sense. And I think when I looked, SEC had 18 holdings. The other funds have sort of high 40s. Would
Yeah.
you expect the more concentrated portfolio to have more volatility in its NAV?
I guess it has the potential risk well, it has greater stock specific risk because it's taking a much more concentrated approach to investing. It's doing that, leveraging the benefits of the closed end investment trust structure relative to the open ended funds that we manage on behalf of other clients. It will have more volatility to the extent that the individual holdings that it holds are more volatile, and it's our job to try and pick businesses that are going to, at least double our money over the 3 to 5 year time horizon that we're looking at. And we're less concerned about short-term volatility in share prices and much more concerned about the long-term value creation we can make. And because we're avoiding some of those more cyclical parts of the market and some of the sectors which are inherently more volatile, we think that, compared to other funds in the sector we managed by our peers, it should be should be less volatile, and that's what we have experienced over time. But clearly, in any individual period, if you have one share price which moves dramatically because of a takeover or because of a profit warning or something, then that will affect the volatility of the overall fund.
Mm. What's the largest proportion of any one company that you own? You said that you've gone
Mhm.
down the market cap
Yep.
spectrum. Um,
Um,
and how quickly could you sell it if something went wrong?
Yeah, so we don't have a limit other than that we would be limited by the takeover rules. So we wouldn't own more than 30% of the company because we don't want to be
Okay.
sort of triggering a mandatory offer for the business. But we don't have a hard limit other than that on the equity stake we can take. In fact, we think it's desirable. We're trading off. There's a trade off between liquidity, influence, and value opportunity. Where we find something which we are have high conviction will give us a really attractive return, and then we want to own as much as we can of it within reason, within the overall portfolio construction. So the equity stake is just an output of getting the right position size for the fund in a company we have high conviction in. And yes, there is I guess a liquidity constraint for having a large equity stake. But the other side of that is that you have a lot more influence over the companies, and often we find that some of our businesses, our exit will be through a trade sale or a takeover of the company, the whole company. In which case, by having a large equity stake, we're in the conversation around what the price is, whether or not the company should be sold, and we don't get businesses we really like taken out at prices which we don't like and where we can't do anything about it. We're typically sort of in the conversation with the management team, the board, and any potential bidders. And frankly, if we don't want to sell, then it might well prevent the whole thing from happening.
Would you consider yourself an activist investor?
I like to make the distinction between activist investors and actively engaged investors. We're definitely the latter. So we are actively engaged with the management teams and the boards of the companies we invest in, but we're not activists in the sort of sense that people think of with where we're trying to find turnaround situations and get heavily involved and be aggressive and fire people. That's not what we're trying
Yeah.
to do. We want to find good quality businesses with good teams that we can work with. But we believe, because of the private equity heritage that we have as a team, because of the private equity business and network that we've got within Gresham House, there are usually ways that we can engage with those businesses to help them, whether that be giving them advice on strategy and governance, or potentially making introductions to either organisations or people who can help them to execute their strategy, then if we see that opportunity, we'll do that. And if we've got a good team who are open to influence and can recognise the value of it, then hopefully they're more than happy if we do that.
Yeah. How comfortable would you be with the fund getting in size? Because as it gets bigger, it would be harder to have
Yeah.
such a concentrated portfolio of small companies.
Sure. So I think we think the strategy scales to around about 500 million. So it's currently the portfolio, or the trust, is about 200 million of NAV. So we think it's got considerable capacity to grow from where it currently is without materially changing what we do, and still sitting within that core small cap part of the market where there are lots of opportunities, there are under research, underappreciated opportunities, and where we have the network and the skill set to get involved and to hopefully add value. So 500, I'm comfortable. I think you wouldn't. This couldn't be a £10 billion strategy, much as I'd like it to be.
I slightly asked that because of the Odyssean bid that came
Yeah.
towards the end of last year, but it looks like for now that's behind you.
Believe it's behind us. That's certainly the board have supported us continuing as an independent manager, and as far as I'm aware, there's no sort of intention for Odyssean to come back.
Yeah. Can you give me some examples of what your favourite holdings are, or the investment case for any of the ones you think look particularly promising?
Yeah, so if I talk through some of our larger holdings, because it's a high conviction fund, we try to put the most capital behind the ideas we have the highest conviction in. Therefore, by definition, the things which are the largest size positions in the fund should be our highest conviction ideas. So we have a big stake and a big position in a company called Medica, which is an outsourced teleradiology business. So it's in the healthcare space, and it's taking advantage of what is a structural undersupply of qualified radiologists in the UK market, and globally, in fact, a structural undersupply of qualified radiologists and an increasing demand for imaging as a component of diagnosis, and also in increasing in clinical trials for new drugs. So they have a platform and a position whereby they employ and engage with trained radiologists who can interpret scans in all sorts of different areas. They sell that service into the NHS. So if a hospital doesn't have available radiologists on call at any given time, then they can go to Medica, and Medica can provide that service to support the clinical process. So it's an area which, because of that structural driver in the market, is not particularly cyclical area, and it's an area which we think there's likely to be double-digit growth for a considerable number of years. They've relatively recently moved into the clinical trial market, so they were focused on the NHS. They've with our support, have diversified their business, made an acquisition of a US business called RadMD, which is selling a very similar service but into the clinical trial market. So sort of tapping into that big structural growth area of pharmaceutical outsourcing, which we believe is an attractive long-term area of the market to try and find opportunities to invest in. And they've also have a business in Ireland, which is similar to the UK business, but sort of a few years behind in terms of development. Therefore, we see good scope for growth there. The reason why we like it, it's a high quality management team. It's not a cyclical market. It's a structural growth area where they have a strong market position. It's a capital light business model, so it can grow without having to consume lots of capital to do it, and therefore it can generate cash, which will either go to shareholders or can be reinvested to grow through acquisition. It's an area where technological changes is really sort of potentially a catalyst to accelerate the business or reinforce their market position. So through things like AI and machine learning being applied to the interpretation of scans can massively increase the productivity of the radiologists, so they can do more. But again, when you've got a structurally undersupplied market, that's beneficial. We think that over time, as the business grows and sustains a premium growth rate, as it diversifies away from the NHS, which it's doing, and as it increasingly uses technology to underpin what it's doing, it can deserve a material re-rating. And then the confidence we have about the rating is also underpinned by observing private equity transactions in the same space. So a close competitor of the business has recently been gone through a private equity management buyout at a EBITDA multiple, which is a material premium to the multiple that Medica trades on the public market. So we think
Mhm.
there's, if the public markets don't re-rate it, then we think there's an opportunity for somebody to come in and to explore that arbitrage, which we've seen a lot over the last couple of years in public markets.
Yeah. How significant do you think M&A is for the investment case, the type of companies you're investing in? So
It-
it looks like you bought River and Mercantile just before
yeah,
Schroders
um,
bid.
yeah.
Good timing.
We invested in River Mercantile after Asset Co had taken a small stake in the business, and we could see that was a catalyst to evaluate the different components of the business, and we could see a really clear sum of the parts sort of opportunity where the solutions business, the fiduciary management business, and the asset management businesses were put together, both independently interesting businesses, but not being valued by the public markets at what each of them would probably be worth if they were separate. So we felt that there was an opportunity either to the business to tell the story better, or to divest one or other of the divisions. And as it happens, they divested one business, this fiduciary management business, to Schroders, and then Asset Co have acquired the asset management business, which has sort of unlocked the value. So, probably we'd have liked to have a bigger stake before that happened, and it happened a lot quicker than we anticipated. But the thesis has played out. In answer to your question about M&A, in terms of exits for our holdings, we don't invest in companies just explicitly because we think this company will get taken out on a short term view. We're long term investors, but we are looking for companies that either have strategic value in their industry, and where we think the market isn't factoring that in properly, or they're companies that can build strategic value over time. And so we think we're pretty well plugged in through our private equity business and our heritage in that area to sort of to know what private equity or trade buyers are looking for and what they value highly. And if we can find those characteristics on the public markets sort of at an undervalue relative to what we think the fundamentals should be worth, then if the stock market doesn't eventually appreciate them, then there's an alternative way for that to be realized through a takeover. So we're not explicitly going for takeovers, but inherently the kind of companies we like typically are attracted to private equity and trade as well.
Hmm. Do you worry about the best quality UK PLCs leaving the stock market?
Sometimes, yeah. I mean, I think there's been a whole spate of takeover offers in the UK market, not just in small cap, right across the market cap spectrum over the last couple of years. And I think one of the main reasons for that has been what I said at the beginning, which is the UK equity market looks undervalued relative to other developed markets, and then you've got a further discount for UK small cap. But within that very broad sort of categorization, you have a whole host of different interesting businesses in structurally growing areas and with high quality fundamentals, and where you've got a UK domiciled and listed business, but which has got international scope, might have more than half of its operations in the US, and it's being valued like a UK small cap when private equivalent businesses are going for much higher multiples in the private markets. There's a clear arbitrage there, and it's our job to try and spot the opportunities. And yeah, we don't want every good quality company to get taken out, obviously, but ideally these businesses will be re-rated as public companies, and their value will be appreciated by the market. But at the moment, there's a lot of opportunities which are not where that's not the case, and some of them are getting exploited by private equity. However, there was a lot of IPOs in the last 2 years as well, so there
Yeah.
has been some replenishment of good quality companies.
Do you participate in IPOs?
We have historically participated in IPOs. We think because of our touch points in private markets, we've got a very good opportunity in the sectors where we focus and the types of companies we like to evaluate those businesses and reference them through our network. So whether it be the management teams or the track record of the company, often we can find people that we know and trust who've interacted with those businesses, can reference the people, or possibly even bought or sold those same businesses in the past. So we can get a good insight into the quality of the businesses and the people, which maybe other public market participants would be less able to do.
Yeah.
So we're quite comfortable investing in IPOs, but we are very selective about it, as we are with all of our portfolio.
You spoke about some structural growth areas earlier. It looks like healthcare and financial services might be the sectors that you see the most opportunities in. Just looking at fact sheets, do you think that's fair?
Those areas are areas which are sort of heavily weighted within the SEC portfolio at the moment. But I'd say they are areas we like. Definitely, there are areas where there are structural growth opportunities and changes happening in those markets which can be beneficial to the right companies. They're not the only ones which we focus on. I think the sector weightings in a trust like SEC, because of the concentration, is much more sort of function of the bottom up stocks that we've specifically picked, rather than a sort of deliberate attempt
Yeah.
to have a certain weighting in a certain sector. But those areas you mentioned, so healthcare services, particularly companies that are playing into the pharmaceutical outsourcing trend, and where there's billions of dollars being spent on services and technology that can support the drug development process. We think that's a long-term opportunity, and we sort of have a number of investments, both public and private, across Gresham House, that play into that theme. In financials, we think pensions and wealth management, the IFA sector, there's a lot of consolidation going on there. There's lots of regulatory drivers making things changing and are driving economies of scale. So there's lots of opportunities to find businesses that are on the right side of some of these big trends in that space, which we can make money for our investors out of. But we also like things like e-commerce, but particularly businesses that are selling into that channel shift. So not necessarily the retailers themselves, but businesses that are suppliers into that change. So we had a investment in Clipper Logistics, which is a third-party warehousing logistics supplier, but specifically set up to support e-commerce businesses, but also multi-channel businesses that are shifting towards e-commerce. So they'd do all the returns for ASOS in the UK, so it's a pure play online retailer, but also they manage the click and collect activity for John Lewis, so it's a traditional retailer, but moving more into e-commerce as a proportion of its overall mix. And again, big structural shift. Finding the right business that's doing the right things that are sort of capitalising on that trend is where we like to play.
How many companies pass through your filtering system for you to look closely at them? Because if you've got a portfolio as concentrated as 18 holdings,
we see hundreds of companies a year, as a wider team. So we'll meet 400 or 500 companies a year in terms of company meetings. So, and I think it's important, particularly in small cap, to see the whites of the management's eyes, and actually or see the end of their Zoom call if in the last couple of years, and actually hear from the horse's mouth how they articulate their strategy and what they're trying to do. So that is a resource-intensive process, but we have our own proprietary screening models, which particularly focus on areas, I guess, proxies of quality. So things like margins, free cash flow generation, earnings growth, return on capital, balance sheet leverage, all these the sort of financial characteristics which would indicate that there's a quality company there. They don't all have to be sort of perfect, but it's a good sort of way of trying to, I guess, filter down from lots and lots of companies we could invest in down to a relatively small number we end up actually investing in.
I thought it was quite interesting. In your report, it said SEC will not invest in extractive sectors such as oil and gas and mining, nor balance sheet financials, banks, insurers, as the manager believes that success in these businesses is often driven by macro factors like commodity prices, which is quite interesting because lots of people do it for ESG reasons instead. But theoretically, why rule anything out?
We try to focus on areas that we understand and have expertise in, and have a network where which as a core part of our research process is to go to our network and try and find genuine experts and operators in those sectors or situations that can help us to validate the judgments we're making when we make an investment. So we have really well developed networks in certain sectors. Oil and gas, mining, those are areas which we've never invested in, and therefore don't have those same networks. Now, could we build them? Possibly, yes. But as you rightly pointed out, the other reason why we try to avoid some of those sectors is because they have big cyclical external factors that are outside the control of the management teams of those companies and our area of competence. So I'm not an expert on the oil price, and I wouldn't want to try and call where it's going to go. But an oil and gas company, that could be the difference as to whether that we make money out of investment in that sector or not. So we'd rather remove big external risks which can drive volatility and can make or break the investment case without us really being able to assess it effectively, and focus on those areas where we're backing a strategy, a management team who can, and the execution risk of that strategy is one of the key risks. And then we have to try and work out why we believe that execution risk is worth taking, rather than trying to call the oil price.
Yeah, that makes sense. Well, I'm afraid we're running out of time, but a few light-hearted questions for us to finish on. If there was one thing you wish you had known when you started being a fund manager, what would it have been?
Gosh, that's interesting. I think the thing that I've learned over the years, which perhaps I could have, if I could advise myself from 15, 20 years ago as to what to do, is to back your own judgment, but also constantly reappraise it. So I think when you're starting out, you have high conviction in your own point of view and your own view on something, but you don't necessarily have the humility to admit when you were wrong, or admit when something's changed, where the facts have changed. And I think what I've definitely learned over the years is that you need to constantly sort of take a fresh look at things, be humble enough to let other people sort of take a fresh look at one of your ideas and challenge it, and not just sort of be rigid about thinking you're right. And I like to think I've learned that, and I'm sort of fairly pragmatic now. And if facts change, I'll change my view. But I probably wasn't like that when I first started.
I think that's very good guidance. It's something I've been thinking about quite a bit recently. Extrapolating between luck and skill
Yeah,
is
yeah.
very difficult. And final question, if there's one book recommendation you could give our listeners that's influenced you?
Okay, well, I'm going to go with a bit of recency bias because I've just been reading it very the most recent book I've read, but it's called um, Richer, Wiser, Happier by William Green. It's basically um, a, I would like this, wouldn't I? Because I'm a fund manager, but it's a guy who's gone round and interviewed various of the sort of most successful and long-term successful investors over the last sort of 50 years, and so he's gone and spent time with Warren Buffett and Charlie Munger and people like that, but also a whole host of others, and trying to just take what is it about how they do things and that has worked for them, and then try and sort of distill that into a set of principles or advice to people so that they can try and in their own way emulate what they've done, possibly not to the same degree of success or billions of dollars of profit that they've made, but and so it's just fascinating, just trying to for him, he's done a great job of just demystifying what some of the people do, and it's not just about how do you make money as an investor, but it's also some quite basic principles about how they live their lives and kind of how they think about the wider world and how they interact, not just about investing, which is quite useful life lesson. So
Yeah, I agree. It's a brilliant book. We actually had him on the podcast
did you? Oh, okay.
a few months ago, so people can refer back if they want to.
Yeah.
No, yeah, it was great. It was really drove home decision making, clarity of thought, and how to do that. And I think one takeaway I had was also it didn't necessarily improve the quality of their overall lives, some of them.
Yeah, true.
Anyway, Ken, thank you so much. That was really interesting. That was a great tour of the funds and your investment process, and thank you for coming on.
Thank you.